When most traders look at a chart, they think they are reading the market. But most of the time, they are only reading half of the story. They see candles, they see patterns, they see support and resistance. They see price breaking out, pulling back, or reversing. But they ignore the one thing that tells them whether the move actually has strength behind it: volume. And this is why so many traders get trapped. They see a big green candle and think, the market is bullish. They see a breakout and think, this is the move. They see price pushing higher and think, I need to enter before I miss it. But price alone can lie. Price can break a level and fail immediately. Price can make a new high while the move is already weak. Price can look strong while the real money is already leaving. That is why volume matters. In this video, I'll show you one simple mental model that changes how you read every candle. It is called effort versus result.
Welcome to Trading Pure, a channel built for beginner traders who want clear, realistic, and practical trading education without fake promises or confusing jargon.
Let's get into it. Most beginners treat price and volume as two separate things. Price is up here, volume is down there. They read price first, and maybe they glance at volume later. But that is the wrong model. Price and volume are one conversation. Price tells you what happened. Volume tells you whether the move had real participation behind it. Think of it like this. Price is the headline. Volume is the proof. A big candle without volume can be suspicious. A breakout without volume can be weak. A reversal with huge volume at a key level can be important. So from now on, do not only ask, where did price go? Ask the second question. How much effort stood behind that move? That is the whole game. Effort versus result. In trading, effort is volume. Result is the candle. Effort means how much activity, pressure, and participation came into the market. Result means how far price actually moved. Imagine pushing a car up a hill. If you press the gas hard and the car moves far, effort and result match. That makes sense. But if you press the gas hard and the car barely moves, something is wrong. Maybe the car is stuck. Maybe the hill is too steep. Maybe something is blocking it. That is exactly how volume works. When volume is high and price moves strongly, effort and result match. But when volume is high and price barely moves, the market is telling you something important. There is a battle happening under the surface. So let's break this into three simple cases. Case 1. High volume and a big candle. This is the cleanest case. Volume is high. The candle is large. Effort matches result. A lot of traders participated and price moved strongly. This shows conviction. For example, if price breaks above a key level with a strong candle and strong volume, that breakout has more weight. It does not guarantee the trade will work. Nothing guarantees that. But it tells you the move had real participation behind it. High effort, big result, conviction. Case 2. High volume and a small candle. This is where most traders get confused. The volume bar is huge. The market used a lot of effort, but the candle barely moved. That mismatch is important. If there is massive effort but almost no result, something is absorbing that pressure. One side is pushing hard, but the other side is standing there like a wall. Think of water hitting a dam. The water is powerful. The pressure is real, but the dam holds. On a chart, this can happen near support or resistance. Price pushes into a level. Volume explodes, but the candle closes small. That means a lot of orders came in, but price failed to travel far. Someone is taking the other side. Someone is absorbing. This is why huge volume does not always mean strength. Sometimes it means battle. Sometimes it means exhaustion. Sometimes it means the move is about to fail. High effort, small result, warning. Case 3. Low volume, but price still moves. This sounds strange at first. If volume is low, how can price move? The answer is simple. Sometimes price moves not because one side is extremely powerful, but because the other side is absent. If price rises on low volume, it does not always mean buyers are very strong. It may mean sellers are not interested. There is no supply blocking the move. If price drops on low volume, it may mean buyers are absent. There is no demand stepping in. So low volume does not automatically mean useless information. It can tell you the path of least resistance is clear. So here is the simple volume matrix. High volume plus big candle equals conviction. High volume plus small candle equals absorption. Low volume plus price still moving equals the other side may be absent. If you remember only this, your chart reading already becomes sharper. But now let's make it practical with two major volume situations every trader should recognize. The first one is stopping volume. Imagine price has been falling hard. Red candles keep printing. Sellers are in control. Everyone is panicking. Then suddenly you see a huge red candle with massive volume. At first it looks bearish. Most beginners think, wow, sellers are strong. But look closer. The candle does not close at the very bottom. It leaves a long lower wick. It closes somewhere above the low. Now ask the effort versus result question. Was effort high? Yes. Volume was huge. But was the downward result clean? Not really. Price tried to push lower, but it could not stay at the lows. That means someone may have absorbed the selling. Panic sellers were dumping, but stronger buyers stepped in and bought that supply. That is stopping volume. It does not mean the market must reverse immediately, but it tells you something has changed. The selling is no longer clean. The second major situation is buying Climax. Now flip the story. Price has been rising for a long time. Everyone is bullish. Retail traders feel safe. Then a huge green candle appears near the top with extreme volume. Most traders think, this is massive strength. But sometimes, that is exactly the danger. A buying climax happens when late buyers rush in near the top, while larger players use that demand to exit. Retail sees a big candle. Smart money sees liquidity. The candle looks bullish, but the volume tells you there is extreme activity. And if price cannot continue after that extreme activity, the move may be exhausted. The moment retail feels safest buying can be the moment stronger hands are already leaving. Now let's destroy one of the biggest myths about volume. Green volume does not simply mean buying. Red volume does not simply mean selling. Every trade has both a buyer and a seller. If you buy, someone sold to you. If you sell, someone bought from you. Volume counts activity. It does not directly tell you who is winning just from the color. The color of the volume bar usually follows the candle. If the candle closes up, the volume bar is green. If the candle closes down, the volume bar is red. That is not enough. So do not read color first. Read size and close position. How big is the volume? Where did the candle close? Near the high? Near the low? In the middle? With a long wick? At a key level? That is where the real story lives. Size plus close position. That is the key. Now let's talk about volume divergence. Volume divergence happens when price and volume stop agreeing. For example, price keeps making new highs. The chart looks bullish. But volume is getting lower with each push. That means every new high is happening with less participation. The move is still rising, but the fuel is fading. Think of a rocket. At launch, the rocket has maximum fuel. It moves fast. But as fuel runs out, it slows down. Eventually, it cannot keep climbing. That is what an uptrend with falling volume can look like. Price is still moving up, but fewer traders are supporting the move. The same works in reverse. If price keeps making new lows but volume keeps shrinking, selling pressure may be drying up. The market has not reversed yet, but it may be getting tired. Volume divergence is not an entry by itself. It is an early warning. It tells you to stop blindly trusting the move and start waiting for confirmation. Now before we continue, here is the right way to practice this. Do not rush straight into live trading. If you want to practice this framework, click the Exness link in the video description and open a demo account first. Pull up a chart, add volume, and study effort versus result candle by candle before risking real money. The goal is not to click faster. The goal is to read better. Now let's turn everything into a simple 3-question volume check. Before you take a trade, ask question 1. Does effort match result? If volume is huge, did price actually move? If not, absorption may be happening. Question 2. Is volume appearing near an important level? A volume spike in the middle of nowhere may not matter much, but a volume spike at support, resistance, a range high, a range low, or a liquidity area is worth attention. Question 3. What does the next candle confirm? This is the question most traders skip. They see one big volume event and enter too early. But the next candle often tells you whether the signal was real or just noise. If there is stopping volume, does the next candle reject upward? If there is absorption at resistance, does the next candle fail and move lower? If there is a breakout, does the next candle continue or fall back inside the range? One extra candle of patience can save you from a lot of traps. This is how volume upgrades your analysis. It does not replace support and resistance. It does not replace market structure. It does not replace liquidity. It gives those ideas evidence. A breakout with strong volume and a large candle has more conviction. A breakout with weak volume and a small candle is more suspicious. A support bounce with huge volume and rejection can show absorption. A liquidity sweep with weak continuation can show the move may be a trap. Volume does not give you magic signals. It gives you proof. And that is the final mindset shift. Stop treating volume like decoration under the chart. Start reading it as the evidence behind every candle. Price shows you the move. Volume shows you the effort. The candle shows you the result. And when effort and result do not match, the market is telling you to pay attention. So from now on, when you look at a candle, do not just ask whether it is green or red. Ask, how much effort was behind this move? And what result did that effort actually produce? That is effort versus result. That is the mental model. And once you learn to read both price and volume together, you will never look at a chart the same way again. Comment volume if you want a part 2 where I break down real chart examples using this exact framework. And if you want to practice this properly, do it on a demo chart first. You can click the Exness link in the video description, open an account, and start practicing this effort versus result framework on a demo chart. Do not rush into live trading. Open the chart, add volume, and train your eyes first. Subscribe for more trading psychology, market structure, liquidity, and no-nonsense trading education. Thanks for watching, stay disciplined, and I will see you in the next video.